Hi, everyone. If you're on the West Coast, good morning. Wherever else you are in the world, good afternoon, good evening. Hopefully, not good middle of the night, but certainly if you're joining us in the middle of the night, then you have the hustle to be an entrepreneur VC or I don't know. Do LPs hustle? We'll talk about that in this segment. Um, my name is Sarah Lacey. I've been a longtime investigative journalist in Silicon Valley. I've been a two-time entrepreneur who's raised tens of millions of dollars in venture capital myself, so I have been through the pain. These days, I'm consulting with Dessel Group to help make the brand louder and prouder and dig in and discover all of the incredible things that are happening with the 800 emerging manager funds we have helped launch and the hundreds of limited partners that we've trained through the LP Institute who were never LPs before, who maybe didn't even know they were at the level to be LPs, maybe were angel investing and didn't really realize, oh, wait, I could be investing in funds. And now they've gone through our courses and they're investing in funds as well. We're going to get into an amazing conversation, with two incredible limited partners, all about the investing climate today. But before we do, I just want to let you know both of our programs, VC Lab, where you can come and develop a thesis, get your first close, learn everything about starting your institutional grade venture capital fund. The latest cohort is closing imminently. I know we've still got some spots. The previous cohort was one of the best ever. This program has launched 800 venture capital firms, 60% of all new emerging funds. It has double the diversity, the gender diversity of the industry at large. If you're interested at all, go check that out now because the doors are about to close. Also, our LP Institute is about to close its cohort. So, my to-do list done. I can just sit and have a great conversation with these fascinating folks. So let's get going. We've got Boulant and Steve here, two of our favorite LPs in our network. And we wanted to just get into the investing climate right now because, it's look, we're sitting back from the point of view of we see emerging managers doing closes all the time. We see new funds being formed all the time. And is it challenging? Yes, it's always hard to raise money. But meantime, we open up the newspapers and it says no one's investing in emerging managers. And we're like, huh, huh, huh. So part of what we want to do today is get an understanding from your point of view. What is the investing climate? What do you feel optimistic with? And, we'll get down in some weeds about both of your theses, what you like to see, what you don't like to see. But let's start out with getting to know you. Boulat, maybe we could start with you. Tell us a little bit about your career and how you wound up being an LP, but also, like, was that a surprising journey for you? I don't think most people wake up, when they're 15, filling out their, what do I want to do? What should I think about my college? Well, what will get me to being an LP one day?
Boy, that's a long story. Um, I was born and raised in Turkey, moved to the Silicon Valley with my parents, went to UC Berkeley, worked in the semiconductor industry for quite a few years, and decided to do my own startup. And I formed a company in Turkey, company called Airties that did Wi-Fi management. And after quite a few years, built it up. We, we built it up, and then I sold it a few years ago. So had a very nice exit. And then I started doing angel investing. I started investing in some of the VCs in Turkey, and then one of the companies or one of the emerging managers was part of. I went through the VC lab, and then I decided to go through the LP Institute and learned a lot. And really did change the way, some of my thoughts on doing some of these investments. And subsequently, I became an LP in four of the VC lab or the emerging managers. And yeah, and that's basically the long and the short of it.
Awesome. Well, we'll get into more details about which ones piqued your interest and how they were the ones to get over the finish line in just a second. But Steve, let's go to you. Tell us a little bit about your story and how you wound up being an LP.
Hmm.
Wait,
I've
you
been having
disappeared.
issues every time I talk. Let's see if we get this back on. Hmm. I had this technical difficulty earlier. Let's see.
There we go.
You're back.
Okay, yeah, I don't know what was, well, now I'm frozen. Can you hear me?
We
Yeah,
can
just
hear
go
you.
ahead and answer,
Okay.
and then maybe we'll figure it out in just a minute.
Okay. Yeah, no, I had this issue where it would work and then I start talking, so I don't know. I have my 49 I took my wife's coffee mug this morning. It says 49% grandma, 51% badass, so I can't take credit for any of that. So I've been for the last 3 decades plus split my time between um, operating. So I've been part of startup teams. I've been a startup CFO in 30, 40 companies. So I've kind of seen it from that end, raise capital. I've also been an entrepreneurship professor at Berkeley, Blunt, and then I've been on the faculty at San Jose State for the last 20 years, teaching various entrepreneurship and mostly experiential, and then investing. So I've been a angel investor, VC. I've started a couple accelerators. I've been with funds. I'm now mostly investing on my own and through a angel group, Sandhill Angels. And through that time, made my first investment in a fund, I think in late 90s, 1999, Angel Investors LP. I can talk a little bit about that. So I've been investing in funds and also an investor, full disclosure, in Decile and in Premier, the fund of funds. So, big fan of Decile. Actually got involved as they were spinning out a founder institute. Kind of loved what, the vision. So I think I was probably in the first pre-seed close and have mentored uh, a number of the cohorts. Did a session last week, may have done Buon session. So again, happy to kind of answer any and all questions while I try and figure out my technical difficulties here. So apologize.
Amazing. Amazing. I'm wearing a Valkyries shirt because the WNBA team for the San Francisco is in the playoffs. I feel like you should be wearing a Decel Capital shirt with that
There we
amazing
go.
fan
I've got,
profile.
I do have a hat, I think, and yeah, it looks like I'm back here. I switched cameras and hopefully this works. So here's the coffee mug I was
I
talking about.
know. And I have,
Told
this
to
is
my wife. Yeah,
one of the first things my kids ever made for me 14 years ago. So
nice.
your wife and I are on the
Yeah,
same page.
yeah.
I'm just still in the mom phase. All right, let's get back to investing. Now, in a minute, I want to talk about this journey from angel investing to LP because it's where we're seeing the most growth in new limited partners. And I think it's a really interesting journey to I guess walk people through. But let's talk first about the funds that you did decide to invest in. You know, excuse me, like I said, we've launched 800 funds, and those are just the ones that we've launched. So, there are thousands of funds that are probably pitching you guys. You've both had very esteemed careers, you know a ton of people. How do you decide? How do you decide? Whoever wants to take it first.
I was gonna say for me, it's the same with you know same with investing in a startup team. It's all about the people. So when you're looking at a fund one, and particularly kind of an emerging manager that might be a solo GP, you're looking at the person or the team, what they've done, what their network is, what the thesis is. And it's really investing in the team in fund one. Fund two, you can look at logos, and fund three, you can look at performance. So for me, it's kind of what catches my fancy. Why is the manager doing this? What do they have that's unique? And I can walk through as we get into this some of the funds that I've invested in, why I've invested. And again, I'm an individual, so it's different than being an institutional fund of funds where you may have some restrictions on what you do in terms of fund size, capital you can allocate, but and for me, it's also kind of a buy versus build decision. So I could invest, directly in more companies, or I can kind of concentrate in some funds. And for me, it seems to work out both. And there's a number of reasons that I'd like to do that. So I'll let Boulan go, and then we can kind of dive a little bit deeper into some specific examples.
Yeah, I have a very similar theme, thesis, etc. I mean, the number one thing I'm always looking for is I'm looking for some form of operational expertise that the fund that the emerging manager has. I mean, especially, if you're going to go into the early stage, I mean, being just a theoretical financial analysis, I don't think really makes a lot of sense. Uh, you really need somebody who can actually evaluate the companies that they are looking into and have some sort of experience, expertise in being able to do that. So I'm looking for, I mean, these days, obviously, it's all about, how do you use AI? So the companies I've invested in have the fund manager has quite a bit of either technical expertise or has expertise applying those things, and I think they're going to be able to make better judgments as to which companies are going to be able to succeed and where are the holes, where are the gaps that they're being able to address. So again, the people, but in my case, I really am looking for some sort of operational expertise
So just to drill down on that a little bit more, so it's when you're investing in say a deal, you're looking at the people. Where you're investing in a new fund, you're looking at the people. Are the types of people, are the skills, are the qualities different? Is like Steve, when someone walks in your office and you're like YC famously says they can know in like 10 minutes if someone's going to be a great entrepreneur. It's like if you're sitting down from someone and you're like, that's a great entrepreneur, is it a different vibe? Is it a different skill set? Is it a different person than that's going to be a great fund manager?
Yeah, I don't know if, oh, here we go again. I think it's, all right. Well,
Who want you answer
we
first?
had no, no,
Sure.
no, I can go. I'm switching back to another camera that anyway, I'll just keep it here and
You're like
hopefully
John Stewart with a 3 camera
there we
setup.
go. There we go. I could go directly to the laptop, but then it would kind of come in on the side. Um, yeah, I mean, I think it's a different process for me and a start. I mean, a startup, you're investing typically, there's a specific point in time where you're investing in that startup, and they're going to build over, uh, you know, 18 months to 5 to 10 years or whatever it might be. But they're going to have kind of specific fundraising cycles. And again, with safes, you can get in at a lot of different times. But still, with a fund, it's much more of a long-term relationship because looking at investing not just in fund one, but two, three, maybe beyond. So going to take more time to get to know the manager. So I think it's a longer process and a process over time. I don't think I would ever rarely, I'm not, Paul Graham and on to, the rest of the YC partners over the time trying to figure out in 3 minutes if somebody's going to be a star entrepreneur. So even with entrepreneurs, it takes me more time to do that, but not a ton of time. But with, a fund, I'm getting to know that manager over time, and maybe it's 6 months, a year or more. If it's somebody that I've known, and I've done some where I've known the managers for 20 plus years, and then I'm happy to get into first close to help support them and find other LPs to come in. But if it's somebody that I don't know, I'm probably going to take more time and look to come in more on a later close. So I just did one last week where I think I was coming in on I don't know if it's a final close, but maybe close to a final close. So I think that's one difference. And then, you're looking at, Boulan said, being operational away. I'm looking at being operational as a fund. So have you invested? Have you done a syndicate? Have you been part of another fund? How do I know, even if you can find great opportunities, that you can get access and then close these deals? So, those are some of the things that, that I'm looking at.
And just to stick with you for one more second, Steve, a follow-up on that. Over that time period when you're getting to know someone, what does that look like? And is it more you want to get to know their character? You're looking to know how their mind works. You're waiting to see who else is coming in and like what their hustle is, how much they're closing. I know when I was an editor and I'd be hiring reporters when I was a journalist, like I didn't want to see their clips because I don't know if an editor wrote those. That doesn't say much to me. The most important thing for me would be to see their story ideas because that shows how their mind works, which is really what I would be hiring as a journalist. So, what were you looking for over that time period?
Yeah, so I mean, I think that's similar. So if you want to kind of see their story ideas or have them, actually, draft stories. So I'm looking at, um, you know, what are the early investments in the fund and kind of getting to know them. So do you have a warehouse vehicle? Have you done a first close? So I think that's part of it, and then also from those portfolio company standpoint, how are, how is fund manager to work with? How did you engage? How were they, what were they doing as you were going through this process? And, the old joke, right, about any VC is, how can I be helpful, right? And then, um, what do they actually do? So really trying to figure out, and I've seen some, I think, one entrepreneur I've known for a long time that I invested in the early side of his fund, Jonathan Abrams at 8-Bit Capital, founder of Friendster and others. So, very, very, positive feedback from the entrepreneurs they were working with and specific examples of how they helped. So, if they have a small fund and not a name fund, but entrepreneurs want them in, I think that's a very positive side because, a lot of this to get the best returns, often it's about access. And, many, many managers would be able to identify, a promising company, but maybe only some can actually get in.
Yeah, that's a huge point. But let's go to you. With this initial question of sort of what are you looking for when you're, angel versus LP? I know you talked a lot about like operational strength. Is it different? The qualities, the vibe, the temperament, the skills that makes someone a great entrepreneur you want to invest in versus a great fund manager you want to invest in. And, Steve made a great point about when someone's raising money as a company, you got to hop. You have a little bit more time when it's a fund. Do you also like to take the time to get to know people or do you make quicker decisions?
Well, I'm definitely not making decisions in 3 minutes or 5 minutes. I
We
do
can all
take
agree why Steve's a little insane.
yeah, exactly. I mean, I do take some length of time before making a proper commitment, and to get to know the person and how they're thinking, because probably the single most important thing here is getting the right deal flow in and picking the right and being able to pick the right set of right set of investments. So, how are they able to get deal flow in, and how are they able to get access to some of the investments? Because like two or three of the investments that or the emerging managers I've made, they are so good in their specific topic. One is really good at go to market and how do you actually build your product? The other is a PhD in AI. Okay, they're so good in their topics, even though there is a fund or there are other major big name investors in making an investment, they're still able to get an allocation. Okay, because the founder wants these people on their cap table because they want access to them. So I'm looking for that type of a thing where this person has such a great expertise in a particular topic that the entrepreneurs are going to want them on the cap table. And so I'm looking at what type of investments did they make in the past? What did they look at? What were the thesis on their investments? And if it makes a lot of sense to me, then I'm going to go with it.
That's fascinating. What I love about this is, having been a founder before raising money, and I've never been a fund manager raising money, but you do often feel like there's so much pressure on a deck. There's so much pressure on that one pitch, on that one meeting. And maybe you had an off day, maybe you didn't get it across. Obviously there's a lot of bias when it comes to venture investing and people, not just gender, but like, do you look the part of a founder? What I love about what y'all are describing is you're really taking time to get to know the emerging manager. And, when I used to interview people on stage, I used to do these like really long on stage interviews because my view was you could not stay media trained for more than 20 minutes. Like after 20 minutes, the best media training in the world would break down and you would start telling me things and being yourself. And it's a bit similar for what y'all are talking about. Like over that course of period, you're gonna see it's like you're gonna see the scratch paperwork on the math sheet, and it's less about what big deal do they get into, but like you're almost doing a ride along with them, which to me is great if you're the emerging fund manager because you're getting a chance to show your work. It's not all hanging on one meeting. What does it take though? Like how many fund managers do you get to that place with before you decide to invest? Like how many get the ride along, like the you're going to Hollywood American Idol ticket with you guys versus how many are like you meet with them once and you're like, I know you guys get pitched so much. You're looking for a reason to say no versus looking for a reason to say yes.
Yeah, I mean, again, it's a little bit different with funds than companies, and I tend on both to be more conversational. One of my pet peeves is somebody that can't actually talk to you without a deck. I think we've all seen it. I'm sure as a journalist, you've been pitched that way, but a deck is great as a send ahead or a follow up. To have that information, but again. I'm trying to get to know you, and maybe that's also from having been a professor for 30 years and realizing that students, if you put up a PowerPoint deck, they just kind of glaze over, get on their phones, kind of do other things. So really need to kind of engage in that conversation. So with funds, I mean, it's I certainly see a lot, but again, I'm an individual, so I'm not necessarily actively looking for any number. So again, it needs to be something that I see as being at least somewhat unique and, in a space that I'm interested in, I want to learn more about, and I really think that you can be successful there. At the end of the day, it comes down to power law. My first LP investment was in Angel Investors LP, which, Sarah, you probably remember Ron Conway and, kind of back in the day, 1998 or 9, I think, made that. And the fund, it was an index fund of basically of internet startups, and it would have performed horribly except for the fact that one of the companies they invested in was Google. So I'm still holding Alphabet stock at a 20-cent basis when it's at 250 something dollars now. So that's a great example of a power law. And even if you had sold the stock when it was distributed, the fund might have been a 1x if that. Obviously, holding on, it's a different story. So, but that's hard to do if you have a very concentrated fund that's investing in 8 or 10 companies. It doesn't necessarily need to be one that invests in 500. One of my former students, Dave McClure, started 500 startups, so I invested in those first two funds. Doesn't need to be that large, but I think there does need to be data to show that, kind of 25 to 30, investments gets you the diversification that you need. So investing in funds, it's probably not 25 to 30 funds, maybe it's 5 to 10 funds, and I've now done over 30. So I think those are so there again, there's no, I think I invested in 3 this year, which might be um, more than I'll do next year again, because these are long commitments. If you're only investing in one fund, it's still 10 to 15 years. But if you're planning on investing in, 3 or 4, that could be a 20-year relationship. So, this is very, very long game.
Hmm.
Um, and at some point, and I'm sure we'll get into, I don't want to bring this up now, but kind of what's going on now, and distributions versus capital calls, and all
Hmm.
that being a little bit out of whack.
Yeah, yeah. So yeah, I mean, let's talk you brought up the power law, and let's dig into that a little bit, because I said I wanted to get in this idea of moving from angel to LP, and how with these smaller fund sizes that we're seeing, everyone's made a lot about this sort of barbell with venture capital, where the middle's kind of gotten hollowed out, and you have these huge, the big funds are getting huge. But we're also seeing, the emerging smaller funds are getting smaller, and they're able to do a lot more with smaller checks. And that's obviously the world that we're providing like the picks and shovels to. And the part of the barbell that we believe is like doing the real venture capital, frankly, and what excites us and gets us out of bed every morning. So and it's interesting because a lot of those funds are smaller. Like our sweet spot is a fund doing on average a $12 million fund. A similar check to an angel check can suddenly be an LP check. Someone who is writing angel checks can be an LP, and like, that's kind of like you've jumped the ecosystem. You've gone from like kind of the low man on the totem pole to like you're now investing in the VCs. And as you say, Steve, instead of putting all your chips on 32, you're putting your chips on red, or you're putting your chips on a category, and you are able to have, you could not, probably not, I mean, you're pretty amazing, Steve, but you may not have been able to get into Google on your own. Had you not been in Ron's fund, you wouldn't have had that. Which is not to say people shouldn't angel invest. Angel investing is great, but I think it is an asset class for high net worth individuals that's been so untalked about. So Boulant, would love you to jump in here. How do you think about the balance between the two? Because I'm looking at this as a financial journalist. Like I've been in this industry. I see people make money, get excited, go out and start angel investing. And then it's like, wow, I just made 20 bets and they're all gone. It just seems to me like a better way, especially as you were saying, buy versus build, Steve. If you don't
Hmm.
have time to get in the weeds with these companies, do the due diligence, manage them, it seems a better way to play the ecosystem to me.
I agree. These smaller funds, the emerging managers, I mean, it's not only that person, but the team that they build around themselves are doing a lot of the heavy lifting and the work and et cetera. And so they're actually going off, getting their deal closed, and analyzing these companies, and they're going to do a far better job than the amount of time that I'm going to spend on it, right? And so from that perspective, it ends up being very good because they are doing all this heavy lifting and work. I mean, similarly, in Turkey, I'm member of it's called Galata Business Angels, an angel network, and they do a lot of the upfront work of screening the companies and et cetera, and looking at them. And that way I'm able to focus in on exactly what I'm looking for instead of trying to figure out, I really don't want to spend my time doing legal due diligence on a company. Okay. Somebody else can do that just as good as I can, or probably better. So I do like that with a relatively small amount of check, you can get into these emerging managers, and you can get into 4 or 5 of them, and VC Labs is a great funnel of actually looking at all these different companies, what their thesis is, what their expertise is, what are they trying to do. And that's where all of my US ones are through VC Lab.
And I would just say, coming from the founder perspective, I have raised money so often from angels who like want to have 100 meetings with me for a $20,000 check. And I'm like, you
Yeah.
should not be an angel investor, friend. Like, I'm more that I would love your money, but truly, like, you, if you're going to be writing $20,000 checks in a startup, you need to be able to, like, as you were saying, Steve, it's a moment in time. You need to be able to
Yeah.
like have the conversation, get on board, not on get on board, maybe see who else is in the round, go or no go. If you need that level of due diligence for that level of check size, I think you're better off investing in a fund that's going to do that for you.
Yeah, and you made a good point, Sarah, about people that get in and become angel investors. And again, you hear a lot more about the people that have had, huge successes investing in a few than those that lost all their money. But there's a lot more that those have lost all their money. And a
Yep.
fund, the fund may return, may not return the fund, may get, you may get only 50, 75%, but um, you're not going to lose your entire investment in a fund. So that's one difference. And then, yeah, kind of looking at this power law. I mean, I've been investing again for, 30 years now and had some, 10x, 20x returns and kind of a handful of those. And those were really helpful in kind of getting positive IRR. And then I had a 400x. So, invested in this company, um, Ripple that's now, at 40 billion and we invested early in the Series A. So I look at the return on that versus the 10 and 20x and saying, okay, I really needed that to be very successful at this angel investing versus just being successful. And that was luck.
Yeah.
We built an accelerator for Ripple, so they brought us in very early. Also gave us a bunch of their crypto to invest in the ecosystem, and our firm invested in the company too. But again, that was um, timing, knowing the people, but a lot of luck. So um, with funds, it's different. You're gonna ideally you have a 7-10x fund, but then you have a number of kind of 2 to 4x's and you end up with a pretty good IRR. But there's other reasons that, when I first got into doing this early stage, one was co-investment. So it's a great way to get co-investment opportunities. It's a great way for companies either that I've angel funded or that I'm part of the founding team to then know who we want to raise capital from. You've been through that. So that's part of why I do this, and it may be getting smart in different sectors. I'm interested in sports tech now, so I've invested in some sports tech funds. I've invested in crypto blockchain because that's an area that I was interested in, fintech. So it's a way to get smart about the market, see what's going on. You get a ton of information, getting quarterly reports on every portfolio company. I mean, you look at data in PitchBook and see how wrong most of it is because and again, as a reporter you would know that, but they have a bunch of 22-year-olds calling people trying to get
And it's
information
all
to build up this
self-reported.
database. Yeah, build up this database versus actual reports on from funds that have this information. So kind of again, kind of having access to that just kind of makes. And again, I've spent my whole career in this new venture ecosystem, so everything is kind of symbiotic here. So there's not a lot of rhyme or reason to how I got here. I think that was kind of one of the questions you started with was, how did I go down this path? Certainly doubt when I started, even really knew who these limited partners were. I knew, they were pension funds and university endowments and others, but I didn't know it was something that, an individual could do.
Yeah. Yeah.
And there were 30 venture firms on Sand Hill Road. It's very different now with, hundreds or thousands spread across the world and, kind of how do you find these? And so yeah, it's been a lot of fun.
That's fascinating, all of those sort of different reasons beyond the returns to do it. Last week, Adeo and I did a podcast where we were talking about the social game of venture capital and like how underrated that is. And like I think you just did a tiny little masterclass on that from an LP point of view. All right, we are getting rapidly through this hour, and I could go down rabbit holes on all of these things all day long. But I do want to talk about the investing climate. One of the things that I think is so interesting that you guys have both said so far is really you're looking at the people, you're looking at relationships. It's a 20-year game. I mean, all of those things say to me, really, you're not that moved by what's happening in the investing climate on when you're going to invest in someone or not. But let's talk about what's happening right now with with the liquidity crisis people are talking about, with, are you getting distributions back? You know, one of the things that we've been hearing a lot with the emerging managers that we work with is there's certainly not the same liquidity crisis that you see at this end of the barbell because they can do secondaries. There's other, in fact, we've had some of the companies in our portfolio really wrestle with should they hold on or do secondaries when they have, you know, a hot company. I've heard a lot of LPs even telling some, you know, bigger and more established seed funds they want them really selling at the A and the B versus holding on forever. The liquidity game is changing quite a bit at this end. So, would love both of your thoughts on the current macro climate. If it does change the way you invest, if it, you know, hamstrings you and how you can invest. I was having lunch recently with someone who runs, you know, a fund that's kind of one of these rare remaining funds in the middle, and they were just raising money. They have a great track record, but some of the big institutions they went to were like, across all the funds we're invested to, so many of them are in Stripe. Until Stripe goes public specifically, we cannot invest anything else. So obviously that's an institutional game, not a LP game. But are there unintended consequences like that of a macro climate, of a liquidity crisis that do impact smaller LPs?
Well, of course. I mean, you just talked about the, kind of the liquidity. So if an LP is in a number of funds and historically they've taken distributions to reinvest and the distributions dry up, then kind of where is that capital coming from? So I've always been a fan of taking some money off the table. I play poker some, and kind of similar philosophy there. If you're at a casino, figure out, okay, take your winnings and then then get aggressive with the rest. Right? It's pigs get fat, hogs get slaughtered. So if you have the opportunity, if you're a smaller fund, you can sell some in the secondary, hold some, and I think you're going to have happier LPs if there's some money coming back. Maybe your returns are going to be a little bit lower than they would have been, but maybe they're going to be a lot better because you don't know what's going to happen with that company down the road. So that's one thing. But then, smaller funds, and that's something that I'm interested in, is emerging managers, similar to investing um, in startups. You have more options. So if you're investing at earlier stages, putting smaller amounts of capital, you have a lot more options on how you can exit those investments versus coming in later, resetting the clock at every round and needing, $500 million or $1 billion exits versus maybe 50 to 150 million. I think there's data that's I've read recently out there. You probably have it if you did this other um, program, but I've seen some in terms of both returns on funds one and two versus later funds, and also returns on smaller funds versus larger funds, and that most of the gains in the ecosystem have been in smaller funds, and smaller defined probably as under 200 or 150, when we're talking about funds here that might be 5 to 25. So I think that's a little bit different too, but still would fall in that category.
Bulent, what are your thoughts about the macroeconomy and how does it impact you?
Um, I, I mean, the macroeconomy obviously impacts all LPs because, we have our monies in the stock market, et cetera, and that's how we're, funding some of these other investments. But so does that impact? Of course it does. But I'm looking at things from I'm looking at a 5 to 15 year horizon, and and in that, when you're looking at things at that type of time frame, you're really looking at how successful the portfolio is going to be, and are they going to be, if the portfolio is going to be successful, then it doesn't matter what goes on the stock market or the macroeconomic situation. um, the current U.S. government policies, I don't agree with anti many of them, but I don't think they're really going to impact the startup scene all that much. And if you're investing in companies that are really solving real problems, and they're able to grow, they will generate wealth, and there will be an exit. Somebody will buy, and something will happen. So it's more about, uh, are the investments that they're making, are they going to really become something substantial?
But given the constraints on the money going in, given that funds may not have returned money, market may be, money might be tied up in the market, there's uncertainty in the market. Does that mean it is not a good time for someone to launch a new venture fund? Or do you think timing doesn't matter if you've got a great thesis and you're at this, under $50 million size? Like, for people watching this who are right on the fence about coming in this latest cohort of VC lab, maybe they've really wanted to be a VC for a long time, they've been doing angel deals, they've been doing syndicates. Should they be worried about the timing now, or what should they know? What should they know eyes wide open about the timing now versus, is it a thing you try to time, or do you just jump in with your
My
special sauce?
my opinion is timing, yeah, it doesn't matter. What if you're really looking at a thesis that is long term and has big potential, what the stock market is doing, or what the general economic conditions are, is not really going to make that big of a difference. And especially when you're looking at the smaller size funds, less than 50 million, if you're trying to raise 10 million, and you have a very good thesis, you'll definitely find the money, the investors.
A lot of money out there. What do you think,
Yeah.
Steve?
Well, I mean, I think you certainly have to be aware of it. I mean, we had, certainly a 10 plus year period in the early 2000s where, aggregate returns for the industry were zero or negative. You're going to see funds that, deployed during 21, 22 that are going to be negative. So, that would speak more to, kind of be a little bit careful how you deploy. And obviously, you need to be able to raise the funds. So you need to be aware of that. But other than that, as we've all read, some of the greatest investments of all time were made during down periods. And I'm fairly valuation sensitive. So, if your entry price is lower, your exit price doesn't need to be as high. So, I think those are, so again, if you're in a cycle where you're successful in raising a fund, but it's harder for entrepreneurs to raise capital, you're probably going to be in a better position than if things are frothy. But if they're frothy and kind of rising tide lifts all boats, then you may ride along there. So, but that's kind of a long-winded answer to saying no, probably not.
It's just a
I
matter of
wouldn't I
knowing
wouldn't
what game you're playing,
yeah,
probably.
I wouldn't overly focus on on some of those macro trends, especially because um, you're raising your fund now, you're investing in companies that are very early. It's more important that, for later stage companies or a later stage fund, which I'm not, very interested in, then you probably need to pay more attention to that because I think I read something recently, and this goes along to your question about, taking some liquidity, is that historically you think about later stage funds getting that DPI sooner, but we're actually seeing it in earlier stage funds getting that DPI because they're selling some in next round and the exits aren't there for these later stage companies. So
It's
uh,
fascinating. The
it,
game has
it
been
it's
turned on its head.
yeah, it's very counterintuitive and something that I've often done personally is if I have an opportunity to sell in a secondary, and I've done that a number of times to kind of take some off the table. And I'm not going to get greedy, and I'm still holding some. So yes, I like that when funds are thinking about LPs and interested in getting money back to us quicker if they can.
Hmm. Okay, great. Let's start going to some questions. I should say, excuse me, kids back in school and I'm fighting a cough, y'all. Um, I should say, one thing that both of you have said that's come through loud and clear is when you want to invest in funds, you are looking for someone's individuality, what makes them great. What is their sort of proprietary deal flow? How do they think? How can they get in a deal? Why does a founder want them on a cap table? These are all the things that we refer to as your secret sauce. And this is like really one of the things that makes VC Lab a unique program. We are very focused on like not you on paper, not you, the resume, not even really necessarily your results, although that's all important, but like the you of you and how are you going to build a thesis around that and market that. And I think that's one reason our fund managers have a pretty good track record. So a lot of what these guys are saying they respond to, that's what our program is really great at getting you to quickly with a thesis and with a deck. So if all of this sounds appealing to you, if you're listening to this and you're like, man, I can't wait to get me in front of these guys pitching my fund, doors are closing in the latest cohort, check it out. And certainly if like me, you're listening to this and saying, wow, I've wasted so much money as an angel investor. I need to look at investing in funds. LP Institute is also closing. Well, I think we got a little more time, but LP Institute is also doing a cohort. All right, let's get to some questions. So Matthew asks, when you've talked to new emerging managers, what have been the top 3 things that turn you off from investing? Bulan, let's go to you first.
Top 3 things that um, maybe if it sometimes they come across as too much hype, and not well grounded. I that is one of my little buttons, I guess, if I get pushed. If it's too much hype and not realistic. I mean, of course, I want somebody who's got a lot of energy and is is going to shoot for something very, very big. But at the same time, uh, I don't like it when there's just it's all hype and not grounded in reality.
What about you, Steve?
Yeah, one is similar. So, kind of the hard sell, we're building a relationship. I've had, fund managers say, oh, we only have one spot left for an LP. And it's like, I'm not buying a used car. If 3 people show up today and we all want to, kind of invest in your fund, of course you're gonna take our money. I mean, maybe there's been a case where somebody's got a hard cap. I'm not going over it, but again, I haven't seen it. So that's one. And then um, you know, transparency and truthfulness. I mean, that kind of goes with any human relationship, but we had one fund pitching, and it was a partner who had been in another fund, but I think he had been a venture partner, and I don't know how involved he was, but they put a logo up on their history of a company that, as a winner, and it turned out we had invested directly in that company, and it was doing great. At one point, it had like a $750 million valuation, but it ended up failing, and he didn't even know that. So he obviously wasn't involved. And if they managed to
Yeah,
sell their stock earlier and made money, okay, fine, but don't use that when you're coming to pitch somebody who lost money on that company. So I'd say
Also,
those.
that means even a best case scenario, that means you won, but the founders failed. Like that says
Yeah, yeah,
something
yeah,
about you.
yeah. It's not
That's a
not
win.
something you want to brag about. Yeah, yeah. We were the only ones who made kind of made money on that. And I've seen that. If you what was that movie that I've shown my students on startup.com about this startup GovWorks back in the 90s, and they had one of the founders who had kind of disappeared. They had to buy him out at one point before the venture, once there's money on the table, and it was contentious, and they were friends. And then, of course, this guy was the only guy who made money on the company because it was a flame out. But yeah, that would be like that guy running around talking about how great he was that he made money on GovWorks. So yeah, don't
Don't
be
be that
that
guy.
don't be that guy
yeah,
or gal. Yeah, so those are a couple. But again, it's yeah, I mean
yeah,
it's a relationship, so it's two-side, right? You want to get to know that LP. Why do they want to invest, and are they going to be, somebody good to have? Are they going to be around for a long time? Are they going to invest in, kind of multiple funds? Are they going to bring in other people? I mean, um, one of the funds I invested in early. this is all about access. So Liquid 2 Ventures, they were going to get access to the YC companies. The partners were Joe Montana, Hall of Fame quarterback, an actual rocket scientist, and a entrepreneur who had, sold the company to Google. And even with the names they had, I think I brought in three or four other LPs. So I didn't make a huge commitment, and that fund, their first fund's at like 7 or 8x now. So it's done great, but then kind of goes back to kind of wanting to be involved in this people and them looking at me. I wasn't bringing in that much capital, but they saw that I could be helpful in other ways. So
Yeah.
similar with everything, are these people that you want to be working with for a long time,
Yeah.
or is it going to be the angel who's going to ask you, Sarah, for 20 meetings to invest $20,000, and they should probably be paying you $300 an hour for your time or something.
Exactly. All right, let's try to get to a few more questions. Domingo asks, what do you think the impact to the VC ecosystem from the recent executive order of opening 401ks to alternative assets?
Yeah,
I mean, more funds are going to come into the VC world, but I don't think it's going to directly impact. Well, I guess it's an individual decision. They could potentially invest in an emerging manager. But I mean, especially if you're an emerging manager, I think you have to be rather picky about who it's not just money. I mean, it's this relationship.
Great
Are
point.
they going to bring something to the party? But I guess it'll make more money available, I guess is the
Yeah.
I
long
would
and the
think
short
I
of the
would think it
story.
would bring more capital in. I've personally invested through SEP IRA into a number of funds. So if there's obviously a ton of capital in people's 401ks, I certainly would caution kind of people about doing that. But and then also having worked with several alternative asset providers, who do this. Most of them aren't good, and then people are really going to struggle, I think, actually with the logistics of doing that. But it's probably a good opportunity for a startup to come in and build the infrastructure to be able to do
Yeah.
that.
I mean, I do worry about like how that slug of money actually gets
Yeah,
somewhere
yeah,
where it's not going to be wasted.
yeah.
But I don't know. It'll be fun to watch if I were a
Yeah,
journalist.
and how many
Yeah.
people are taking tolls along the way, right? You're already paying 2 and 20, and then what else are you tacking on here, and what does that do to the returns?
Yeah, yeah. All right. Emil wants to know what your portfolio funds look like in terms of sector, geographic focus. What type of funds would you like to add in? Are there areas that, Steve, I love that you said you like to learn from your investments versus double down on what you may know already. So tell us a little bit about where you already are in terms of both sector but also parts of the world, and are there things you're really interested in where you just haven't found a great fund manager yet? And Bulan, let's go to you first.
I mean, I currently live in Istanbul, Turkey, and right now I'm in Palo Alto. But so I do have a bias to Istanbul, to Turkey and Greece. So they're both from my angel investing and also from the VCs. But also I've also started focusing in on the US emerging managers. And so those are my two geographic areas. And I do think that the usage of AI is going to have a huge impact on virtually everywhere. And so I am looking for companies, companies that are actually using AI to get into whatever new vertical that there is. And some of the ideas are just absolutely fantastic. and I think they're going to go very far. So I have a bias for both. In the case of the emerging managers, are they, what is their thought process on how to use AI within their portfolio of companies that they're going to invest in? I mean, you will literally are in a situation where you can have, using AI, you can have a 5-person company that is able to generate hundreds of millions in revenue and ARR and et cetera. So, the whole set of dynamics is changing within the ecosystem. And so I'm looking for those things from a sector basis, and geography, US and Turkey.
Great. And Steve, we're going to let you have the last word. I just want to add into the question thoughts on things like venture studios, funds that are rolling things up, like other sort of structures. What all interests you? Anything you're looking for?
Yeah, I mean, I like different types of vehicles. So I've invested in management companies, and I do mostly US, but there's a European fund where they're investing in sports franchises and sports tech, and I'm in the management company, invested in the management company of a fund, Right Side Capital, because I wasn't clear they were actually going to be able to raise a fund, and now they've done 7 or 8 funds. I did the early funds for a fund with the thesis where they were going to take the excess pro rata from early stage managers, so this proof capital. So some of the things are, again, it's unique, it's a little bit different. And yeah, I'm not particularly looking for anything specific, and I probably shouldn't be investing in many more funds because now I think about um, my stage in life and kind of what I'm gonna leave my kids and grandkids one day, and every fund that I
No,
invest in
haven't you
is
seen all these
10 to
founders? We're
15.
going to live to
Yeah,
190.
no, I haven't. Yeah, I haven't gotten into maybe. Hopefully, I mean, all 4 of my grandparents lived into their 90s. So yeah, hopefully I'll be. And my 91-year-old mother is still playing tennis, and she's leading a hike tomorrow. So pretty good genes, but well, you never know.
Yeah, she should have the grandma
So
badass mug.
yeah, great grandma. She's a great grandma, badass. So uh, yeah, I mean, it's again, as an angel investor, as an individual, the beauty is you do what you want, right? So, if I feel in this one day, I might do this. I'm not feeling it, not going to do it. And I feel blessed that I'm, in a position that, I can do a lot of what I want to do. So,
Mhm.
and at this point in my life, I don't suffer fools. So if I don't want to work with you, I won't work with you. So that's
Yep.
looking for people that I like and want to spend time with, I want to help and support. And I'm doing more personally. More of my time is spent on nonprofits. I'm board chair of a nonprofit called Scholar Match that offers mentoring and scholarships to first generation low income students. So spending a lot of time there and other areas where I can give back and teaching and all that. So love to help. I love the fund managers I've met through VC Lab. I haven't done much with the LP Institute, but definitely I've invested in funds that I've met through VC Lab, and there's so many great ones. Obviously, that's why I invested in the fund of funds through Decile, so I can get a little exposure to all the top funds.
And if you guys think you are that next top fund, doors are closing. You better get in quick. There's not going to be another cohort for a little bit. Thank you guys both so much. This was an incredible conversation. Would that I had a ton of money. I would be running to put it in funds right now because you have sold me it as a better way to invest. But no, seriously, what I love about this company, the reason I'm here certainly is because I think it is so cool how Decile is helping change the face of who gets to be a VC. Because if we change who the VCs are, we change what gets funded, that changes the world. And you guys are helping make that possible. So I think there's few things that could be cooler. Thank you so much for joining us, and we will hopefully see all of you out there in one of our programs soon. Bye, everyone.
Thank you.
Great. Thanks so much, Sarah.
Bye.
Bye.